Dear 2018, in the future you'll have the benefit of hindsight.
But with what we know now,
you might have done things a bit differently.
The questions of the future aren't about what you have, but what you did.
what did you do about pollution and climate change?
Did you invest in industries and companies that were trying to make a real difference?
Did your actions send a message to the world and the people around you?
Did you invest in harmful industries like gambling and tobacco?
Did you ever ask where your money was going? If you did all this,
We thank you.
If you didn't, you still have a chance.
Invest ethically today.
For those of you who haven't seen that video before, I'm pleased to say that that was largely our children, James' son and daughter, and my youngest daughter, plus some of their friends taking part, and they were taking part in it. And it was amazing their response to the request. They really were pleased to deliver that message. It came from the heart, so you probably could tell from the way they spoke there. They aren't paid actors or anything like that. I'd like now to invite Nicolette Boyle to talk about the development of the responsible investment style in Australia. Very briefly, Nicolette has been a key person in developing or taking, I should say, what was originally the Ethical Investment Association of Australasia to a much higher level. Going back to our Hunter Hall days when Mark and I were at Hunter Hall, we originally used to host what was then the Ethical Investment Association in our office because it was such a nascent idea, and it's now a very big thing, and I'd like to Nicolette speak briefly about that.
Thanks, Jack. That is actually a photo of me, taken just a few years ago, in fact. So my job is to, firstly to thank you, because you're here because you believe in putting your money alongside your values, which could not be a more powerful thing to do in terms of sort of democratising capital and speaking with your feet, voting with your money. It's making a difference, so thank you. But my job is to talk about you're going to do it for me, responsible investment, and to say that it's growing. It's growing not just in Australia, but globally. Between 2014 and 2016, globally, assets under management was around $150 US back in 2014. It grew to over 500 billion, US dollars in 2016. That's a compound annual growth of around 86.5%. It's not just growing internationally, it's growing here in Australia as well. We take the temperature of the responsible investment industry every year at the Responsible Industry Association. And of all of the money that's professionally managed in Australia and New Zealand now, we have more than 50% of it being managed under responsible investment strategies. Now, some of that's what we call broad, which is really just considering environment, social and governance factors alongside financial factors. But there's also this core part where Morphic's products fit in, which is where they go the extra step to also then screen out the bad stuff and tilt towards the positive investments that actually go towards making a cleaner, more just and safe economy. So why is this all happening? It's happening really because of a few factors. Firstly, consumers want it. Our polling in 2017 in Australia showed that 9 out of 10 Australians don't just want, but they expect their super funds and their investment managers to put their money into assets and enterprises that do no harm in the least and ideally go towards making a positive difference. Some of the things that they really care about are avoiding rights issues, animal rights, human and labour rights, where there are abuses and violations of these, and things they care about, excuse me, investing in are things like healthcare and medical products, renewable energy at the top of the list, and other things like sustainable companies that are engaged in products and services that make a difference. The other reason why responsible investment is growing so quickly is because it just makes good business sense. So what's really important to note here is our research also shows, it's not just ours, it's global as well, including the big end of town who've been doing these sort of long-term bits of research around financial performance, that a core responsible investment product financially outperforms on 3, 5 and 10 years the standard benchmarks of the ASX 300 in the case of domestic equities. And that's really important. In 1 year, we found it either was on par or underperformed slightly. But this is a really important thing, is that if you have your assets invested alongside your values, you need to be patient with your capital. You need to leave it there because there are flows and cycles. And as it's coming down, it will come up again, because these are products and services that will be part of the 21st century economy, which has to be safer, fairer and cleaner. So I think that's all I was going to say on responsible investing. And again, just thank you very much, because it is investing in products like Morphic's, who are 2 products that we have certified, and we've certified it on transparency, on being true to label, and having a quality investment process. And I can say, having just finished the independent verification audit on Morphic's products, you cannot get a more enthusiastic, dedicated and skillful team of ethical investors than at Morphic. So thank you very much.
It's always dangerous when people surprise me what they said. I wasn't expecting that last bit, and I can promise you it was, I'm very touched. So thank you very much. Just a bit of background on for those of you who don't know less about us than some of you. Morphic Asset Management is a firm that was established about at least 7 years ago. The origins are that my colleague Chad Slater and I left Hunter Hall in late 2011, early 2012, with a view to setting up a business that we felt would have a slightly better fix on risk management, while retaining the elements that have made Hunter Hall so successful over the years. Since we launched our first fund, which is the Morphic Global Opportunities Fund, we're up about 15% compound. And today we now have 2 products in Australia. We actually have 3, but 2 main products, which is Morphic Global Opportunities Fund, our unit trust, Morphic Ethical Equities Fund, which is the LIC, which is, many of you here from the AGM of, and we've recently launched in Europe what we understand to be the world's first, or Europe's first, long-short strategy in an ESG, with an ESG overlay, and there's now a fund in Australia, a feeder fund, that allows Australians to invest in that fund at no extra fee into the European fund. I've just got to briefly talk, and I think some of you will have seen the slide from last year, but briefly about what is responsible investing in slightly more detail, and in doing so, go through the history of the industry a bit. So, way back when, I'm talking about more than 20, 30 years ago, there were a bunch of investors who, institutional investors primarily, who wanted to be sure, typically came from churches and charities, who wanted to be sure that when they were investing in the assets, or when people were investing in the assets of their organisations, they weren't investing in things that were at odds with their personal beliefs. And so that was the origin of so-called ethical investing, which was really about not investing in primarily what we call the sin stocks, that's tobacco, alcohol, and gambling. As time went by, people's interest broadened, and in particular, people got more concerned about, and rightly so in my view, about environmental issues. So there was a move to look or create funds that would not invest in any form of environmental destruction, which more recently has become to be really focused on things like greenhouse gases and the risks to long-term risks to human ability to live on this world if we don't do something to curb that issue. And once we start thinking like that, they then moved more towards thinking about, well, it's all very well to avoid doing bad things, but what can we do to try and deploy our capital without undermining investment returns into companies that are actually going to try and make the world a better place? And that is more about the whole concept of sustainability and really a bit more what we call positive screen. And then finally, the other two elements, if you like, are that have emerged in more recent years are based around impact engagement, which is where you actually go to companies as a fund manager and you say, we'd like you to do things better, different, and we do a bit of that too. And then the final element is philanthropy. We don't feel we certainly have no intention of using the funds of our clients to engage in philanthropy, but we as a fund manager do support charities, and in particular in the Morphic Ethical Equities Fund, we give a portion of our fees to a charity that some of you will have heard a presentation on last year called Bush Heritage, which is engaged in trying to revive basically very badly damaged but high conservation quality land to sustain species diversity and so on. And there's for those of you who had the annual report, there's a brief description of what Bush Heritage does on the back of the annual report. So just to summarise what we do, we are 100% ethically screened against companies that we don't invest in companies that are engaged in sin stocks or environmental destruction. We do some positive screening. We try to have a portion of the portfolio at all times. In fact, we ensure we have a portion of the portfolio at all times in stocks we think are going to work to make the world a better place. We do engage with companies to try and get them to lift their corporate governance in particular. Not always successfully, but we have a go. I'm going to just briefly say that Nicolette, I thought, covered very eloquently the growth in the responsible investment style, both overseas and in Australia. And I think the important thing is not just that more and more people are paying attention to it, but more and more people are doing it in a more serious way. And we think that's going to be very positive for us, because we're a bit of if you like, in the leading pack of that process. As more people do it, the kind of stocks that we invest in, we think will become more sought after. A brief, just a reminder of what it is we don't invest in. I'm not going to go through all these, but you can see the red boxes describe things we definitely don't do. The green boxes are things that we try and find stocks that are working in. And we find generally that the companies that are involved in air and water quality are sometimes the easier ones. Companies that are involved in trying to improve the... we don't invest much in generation of renewable energy, but we do invest quite a lot in companies that are helping get that renewable energy to the marketplace. I won't stress this too much, but we'll have a few examples later. We can also short. We are a long short fund, and for those who want to know more about shorting and have any questions about it, please ask in a second. But we can also short stocks where we think which we couldn't own, and we often make a point of telling the companies why we shorted them, because of typically sustainability issues we think they're not addressing. Portfolio positioning, this is as at the end of October, so a little different from what you have in your annual report. As you'll see, we have a very concentrated, our top 10 positions are quite concentrated. I'm not going to go through all of these. We have some slides on individual stocks, but you'll see that Alstom, which is a French-listed mass mobility company, China Everbright, China Water Affairs, Rural Electrification, and Power Grid are all companies that we feel are part of our mandate to try and invest in businesses that are trying to make the world a better place. On the short side, we also have one investment in particular, which I'll talk about in a minute, which is Coca-Cola Amatil, where we're shorting the stock, where we think there is a couple of ethical challenges the company has not met. And by the way, the key point about that is that when we shun unsustainable businesses or short unsustainable businesses, we're basically saying there are problems with their business model which we think will come back to hurt them in the future and affect the performance of that stock in a negative way. Alstom, the big train that will, and getting a bigger train. Alstom, my colleague James can answer questions on this shortly, but if there are any, but Alstom has been a very successful investment for our fund. It is the second largest producer and operator, also producer of mass mobility in Europe, and also one of the largest players in signalling. And I say in Europe, it's a global company. It's about to merge with the largest player, slightly larger, soon-to-be former competitor, we hope, which is Siemens. Siemens has a mobility division that two businesses are going to be merged together, a great Anglo-French alliance. And the reason for that is that they face incredible competition from China High Speed, which is the fastest rail technology company in the world. And so they've decided to get together to be a more effective global competitor. What I can say is that since we've owned Alstom, their margins have steadily grown. Their order book is at record levels. And this really highlights the fact that all around the world, particularly I should say in emerging markets countries, there's recognition that if they're going to deal with their environmental issues of too many cars, they have to really invest heavily in both urban metro and intercity trains. And this is spreading to incredible places. So earlier this week, Morocco unveiled what will be Africa's first high-speed rail, Africa's first high-speed rail network. It's about 320 kilometers in length. Half of it, which the tracks have already been upgraded, is going to operate at speeds we can't imagine in Australia. I think it's about 320 kilometers per hour. I think James is the person who travels most on rail in our group, because he spends a large part of his time in Bathurst. I think our trains struggle to do more than about 100 kilometres an hour at best. And you'll notice at the bottom of the slide there's a picture of a little blue train there. This is an incredible innovation and a very exciting one, hopefully for Australia at some point. Alstom is very innovative. They've just developed what is the world's first hydrogen train. Why do we need hydrogen trains? Because an incredible amount of traffic, even in Europe, is still going around on diesel trains, because the routes they operate are too small, too infrequent, and carry too few passengers to justify the cost of electrification. So diesel is a wonderful substitute. So hydrogen is a wonderful substitute for diesel. And that's true, by the way, of so many routes in Australia where we still run diesel. We're running diesel through most of New South Wales. And I'm very much hoping that Alstom, which already has a presence in Australia, can start marketing its hydrogen trains. The next stock I want to talk about is a company called China Everbright International. This has been a troubled investment for us. I'll talk about the investment history first of all. So what they do is they do what's called waste to energy. They solve two problems in one go. They deal with the problem of increasing, China has incredibly fast-growing amount of domestic waste while not taking ours anymore. And the problem is, historically they put it in landfill. That's no longer a viable outcome or approach because they haven't got the space, and also they're conscious of the fact that when you dump stuff in landfill, it tends to leach into the soil or generate a methane and greenhouse gas that pollute the atmosphere. So the solution is what's called waste to energy. You get a very efficient incinerator. You take the waste and you burn it, and you generate electricity. So solving two problems: waste disposal, and it's also generating renewable energy. Roughly 1/3 of their income stream comes from the fees they get paid by local authorities to take the waste rather than going dumped in landfill, and the other 2/3 come from the power they generate for the grid. Now, I said it was a slightly troubled investment. We found it about, I'm just looking at about this time last year. We thought it was crazily cheap, and we looked like we were right. As you'll see, the blue line, the dark blue line on this slide, shows our investment history there. And what happened then was it started to fall for no apparent reason. They kept on announcing more contract wins to build more plants. The plants they were operating very efficiently and generating great cash flows, but the shares kept sliding. And we operate at Morphic with what we call a tight risk management process, stop losses. So at a certain point we said, we don't know what's going on here. It's making no sense from an operational point of view about the company, but we have to accept we appear to be wrong, so we cut our position. And then soon after that, the shares plunged. And what we found then was there was a reason. It wasn't a reason to do anything where the business was being run. It was a reason due to basically the ownership of the company. This is what's called in China a state-owned enterprise, or a subsidiary of a state-owned enterprise. And the Chinese government had decided it wanted this business to grow much faster than it was. So they ordered the company to raise a lot more capital, issue a lot more shares, so they could grow faster. And obviously word of that, about that had been leaking into the marketplace. We're often not the first person. I think if you're a global investor, you have to accept you're never going to be the first person to do anything. But of course, as soon as we saw the news about the rights issue, the light bulbs went off in our heads, and we said, aha! Now we know the reason. Nothing wrong with the business, great business, in fact going to grow even faster, but a great disappointment about this rights issue, which was not expected, so we then bought back in. That's why the blue line resumes, and it's now, as of today, roughly near that high level of the renewed entrance. So it's about 685 or thereabouts a share. We invested most of our new money in at about 610 or 615. So that's the history of China Everbright. And also give you a bit of a glimpse about how we manage risk. Coca-Cola Amatil. There's a comma missing here. Should say Coca-Cola Amatil, not sweet as, comma, bro. And the reason why we think it's not sweet is that we've got a number of issues with Coca-Cola Amatil. We think that this is a company which has got problems that are going to come home to hit it. The three problems, I think, really are as follows. The first is sugary drinks are going to be increasingly unacceptable. The company has started to recognise that in Australia and New Zealand, but it has not yet really recognised it. It's two fastest growing markets, fast growing markets, which are PNG, Fiji and Indonesia, where they're quite happy to keep on selling highly sugar drinks to populace that's got growing problem with obesity. And by chance, both Chad and I have had a long personal history in the South Pacific, so it's an issue we feel quite strongly about and also know a lot about. The second problem is waste. Coca-Cola is a big generator of plastic bottles and waste. Yes, they have to now pay for part of the recycling cost of that waste they generate. They don't yet have to pay for it in their emerging markets, in those countries I just talked about. We think that's going to come home and hit them. And the final problem is we just think the disclosure of the company is very poor. And we really became most aware of this when we asked them some questions, genuine innocent questions about challenges they were facing in getting their money out of PNG. So for those of you who don't know PNG is quite a difficult economy, and they have a currency, the currency there is called the Kina, and it used to be quite convertible. You could easily take your money out of PNG in Kina and convert to Australian dollars. It's now extremely hard, something that Chad and I are both very aware of. When we asked the company about that, they tried to pretend there was no problem, and we pressed them and they admitted there was a problem when they came back to us, but we just find that level of disclosure to be unacceptable. I'm going to just jump, if I can, sorry to be a nuisance here, but I'd like to just briefly jump to slide. Sorry, I'm going to get here in a second. It's a slide with the. Okay, thank you. Now, talk about disclosure and transparency. At the end of March, we were feeling pretty good about ourselves. This is Morphic Asset Management. The funds were performing well. We were a bit upset about the discount to the NTA for the share price, but we felt at least the stuff we could really control, the investment of the fund, was going quite well. We'd actually generated, to give you some idea how well things were going, we'd recouped all the issue costs, and we were actually outperforming the market to the point where we actually had generated a small performance fee. Sad to say, and we covered this in the annual report, our second 6 months didn't go quite as well. In fact, they went quite badly. And we've obviously been doing a bit of soul searching. Why did we do less well in the second half of the year, to the point where we're now underperforming the index? And I will take up the point that Nicolette made. Unfortunately, our style of investment is going to tend to have periods of underperformance. Any style of investment has periods of underperformance. But if I think about the real issues, we sat down and thought about why have we done bad in the second 6 months. The reasons are really in no particular order, but we tend to invest in small and mid-cap stocks rather than mega caps. It was only the mega caps, the Apple, the so-called FANG stocks, basically did really well in the first half of the second half of our financial year, March to September. So we weren't invested in those at all. The second challenge we have was that we tend to invest in what are called value stocks, that is cheaper stocks rather than high growth, highly priced stocks. Again, wrong place to be for that 6 months. The third challenge we faced was that we tend to find our best opportunities are in either Asia or emerging markets, which often is both, and they were the worst performing markets during that period. And finally, and this is obviously reversed a bit, we have a zero energy exposure, and that 6 months was a period when the oil price was going up quite a lot, and that clearly didn't help us either. Now I've got to say that October, that was a pretty horrible month in terms of absolute returns. We did actually generate some outperformance, and so far this month we're also generating some outperformance. And that is really, again, it's not that we suddenly become geniuses. It is, to be honest, the reversal of those trends I discussed before. So you do get these periods where you get underperformance because of the nature of what you do, and then some recovery as that comes back into fashion. And we hope that will be maintained for the rest of the year. If I can go back, Eva, to where I was, which is talking about our outlook. I hope many of you get our half-yearly reports from investors, which we issue to investors in all our funds, looking at the stocks we own and what's gone right and what's gone wrong. One of the most dangerous things we do in that report is we unleash our so-called hostages to fortune, where we make 5 predictions about what we think won't happen in the next 6 months. So there we were, sitting down at the end of June, early July, preparing these negative predictions. And I have to say that this is the real frustration for us. We really think we should have done better as a fund, given that we got most of these more or less right. And this commentary is as of mid-October. But so our expectations, and I want to go through all of these, were basically that the US would actually do better than everybody expected, might even deliver some positive results. It did. We thought, paradoxically, Australia would do pretty badly, and it did. We thought that US corporate bond rates would not actually, they would go up, which they did. And we thought that US government bonds would not continue to sell off. Everyone was panicking about that time. And finally, we felt that Trump's core popularity would remain intact. Now, you might wonder why the hell we cared about that. Basically, we feel that as long as Trump feels his true supporters are still supporting him, he won't act, I'll use the word more irrationally than he sometimes seems to at the time, which is obviously going to be good for markets. I'm just going to briefly talk about Australia. Why is it we are, to the extent we're allowed to under our license, encouraging people to invest more globally rather than in Australia? I guess it really comes down to the thing that I don't say with any great pride or joy as the owner of a nice house in Bondi, but we do think the Australian property market is in quite a delicate place. Now, the chart on the left, which you probably can't read, but in your bags, you probably have a soft copy of this, a hard copy of this, shows the sell-offs that occurred in Australian property over the last, I think about 30 years, going back to the 80s. And you see, typically, when the Sydney property market corrects, starts to fall, it typically only falls 8 to 10%. That's about it, and then it recovers. What concerns us now is that we think that this current sell-off is slightly different. The main reason for that is that it went up more, longer, beforehand. Therefore, the likely rate of decline is probably, or level of decline is going to be greater. So we thought we'd compare, and this is obviously not a perfect comparison, but we're comparing here the light blue line is the history of the Miami property market through the GFC and then the recovery afterwards. And you can see the Miami real estate market basically doubled in a space of about 5 or 6 years. Incredible rate of growth. And then it fell, it halved. It fell from an index of 120 to about 60, and then it's had a slow, gradual recovery ever since. The dark blue line is the Sydney property market up to date, and obviously we're trying to match the curve of this thing. And what you'll see is the Sydney property market went up pretty spectacularly over a long period. It didn't go up as explosively as the Miami property market, but our view is it will have a somewhat similar shape to the recovery, or to the further sell-off in the recovery. It won't probably fall as far, but what we feel people should be aware of is it could probably fall another 15–20% and be entirely consistent with what's happened in other property markets around the world. Now, why does that matter? It matters because the Australian economy and the Australian stock market is so closely linked with the Australian property market. Our banks, their main business is lending to homeowners and investors in property. Our retailers, our biggest retailer, one of our most successful retailers is Bunnings, which is a very high linkage to the property market, but all our retailers depend on consumers feeling happy about their economic position. And when house prices fall, people who own those houses experience what's called the negative wealth effect. A wealth effect is when you feel richer because your assets are going up, and a negative wealth effect when that goes into reverse. And when people feel a negative wealth effect, they tend to consume less. So that's another major part of the Australian economy, retail, that's already got challenges, and also a large part of our stock market. So those two elements, we think, are a slightly toxic mix for the Australian stock market, and why we feel that probably it is not going to be the greatest place to invest, and you're going to be better off for all the excitements and risks, you're going to be better off to invest in global equities. Finally, I'm going to just talk about portfolio positioning. Where was the fund at the end of October? I'm not going to go through all. The orange line here shows the index weighting. The light blue line shows the Morphic ethical equities exposure, and the dark blue line shows the Morphic global opportunity. And the general points I'll make are as follows. First of all, we are a little underweight. We were at the end of October a little underweight the US, a little overweight Asia, and quite a lot overweight in India and what's called Middle East, which really means in this case one stock we own in Israel. And from a sector point of view, we are underweight. We were and we remain underweight tech, and we remain slightly overweight financials, mainly due to a couple of exposures we have directly in Asia and the Middle East, and we are overweight utilities, mainly due to some investments we have in India and China. I think at that point I'm going to probably just go straight to questions. And I'm going to direct traffic here, by the way. I'm going to try and get some of my colleagues to speak where possible. So, first questions.
Jack.
So we have a microphone, I think. Oh, sorry.
Sorry, Jack, just that last slide. Do you cash? What percentage are you cash, or are you fully invested?
We are close to fully invested. I'm going to just get Jeff. Do you mind just telling exactly what our level of cash is at the moment? 3%. So our view is that, and we do run the cash up and down at the margins quite a lot. But our view at the moment is, and I'm feeling better about this today than I did yesterday, but our view is that it's probably not a major sell, or we've seen the bulk of it at least. Stocks in most markets have now gotten to be, I think, attractively cheap.
Hello, Jack. Question for you. I understand that there's been a change in, or it's introduction, or it's going to be introduced, change in the rules surrounding reporting on supply chain management and human rights for sort of anti-slavery for public companies with revenues. I think it's 100 million. How will that fit into your sort of granular analysis of companies and your decision making?
Okay, I'm going to pass the bulk of this question to my colleague James, who's really done a fantastic job on developing what we call our ESG audit. So James, perhaps I can hand that to you and you can have a go at answering that one.
The caveat to my comments is that I'm not entirely on top of... Sorry. Take the mic.
Take the stand.
As you'll detect from my accent, I haven't been in Australia all my life, so I'm not entirely au fait with the political system here, and neither can I vote. The Modern Slavery Act is currently in Senate, I think. I'm looking at somebody who knows more about this than I do, although I hopefully know a lot. And when enacted, now the legislation has already been enacted at a state level here in New South Wales, but I believe the policymakers are looking very much to the federal act as and when that passes for guidance as to how to enact this. But yes, broadly, companies with over a certain threshold of revenue will have to report on their responsibilities in respect of addressing modern slavery within their business and particularly their supply chains. So it's very important for us not only to rely upon those Australian companies that report where we're invested, but for any company in any part of the world to ask questions as to their understanding of the exposures within their supply chains to the issue of modern, the many issues that are encapsulated by modern slavery. So for us, it's not just an Australian local issue. It's a question, a set of questions we ask of every company that we invest in. Now, for many companies, supply chains are very long and complex, so it's a challenge for everybody, not just for us, but also the companies that we invest in. So we actively engage and push them to do as much work as they possibly can do in uncovering bad behaviour within the suppliers to those businesses.
If I can just follow up on that. I mean, I said before we mostly invest in smaller and mid-cap companies. Generally, it's the very large companies that have the most complex supply chains. And it is a real challenge. I mean, the one that we all probably have some awareness of is that most of us have a thing in our pocket called a mobile phone. That mobile phone will almost certainly contain a mineral called derived from a mineral called coltan, which is typically mined in very nasty conditions in the Congo. And it's very hard for these companies to actually to be confident, I think, that their coltan is coming from a sustainable source, and those mines are run effectively with slavery. I hate to say it. So it's very difficult, and it's a real challenge to global investors. I'll give you a little anecdote. Many years ago, I was with one of my former colleagues, and we were visiting what looked like a very cheap and fast-growing company in Korea, South Korea, that is. And we asked them about what their operations, and they were very proud. They just set up the first joint venture company to produce garments in North Korea. We thought it was interesting. So we asked them, what's the cost differential between what you have to pay your workers in South Korea and what you pay your workers in North Korea? And they scratched their heads and said, we don't really know. And we said, what do you mean you don't really know? We don't pay the workers in North Korea, we just pay the government. And I can draw your own conclusions. So I hope none of us wear any clothes made by that company.
I was just wondering, in the ethical fund, can you invest in Australian companies? Surely there are opportunities here.
The answer to that question is yes, and we do actually also short Australia. We currently don't have any positions in Australian, long positions in Australian ethical fund companies. Oh, sorry, that's not quite true. I apologize. We don't have any positive screen companies. We have some long positions. We have a long position in, believe it or not, one of our rivals. We have what's called a long short pair. We have long Magellan and short platinum. That's the main example of an Australian company we own. And just simply because we think that that's a better run business.
Can you explain why you are long Magellan and short Platinum?
Okay, I'm going to hand over to my colleague Shad. He's been looking forward to this all day.
I've had this question on every leg of the roadshow. So, first and foremost, we're in the business of investing in other businesses. We are not in the business of making opinions on other fund managers and whether you should allocate money to them. So this is purely a valuation and business-related story. And the story here is fund management businesses are pretty straightforward. Costs are largely salaries, not much else. Revenue is determined by funds under management times by annual management fee. So what determines funds under management is historical performance, predominantly, over 3 to 5 years. So if you have a negative 3 to 5 year number, you on average have outflows out of your business. And if you have outflows out of your business, on average, your profit falls because your costs don't change that much. On the other hand, if you have positive inflows, positive performance on 3 to 5 years, you have good numbers as well. So therefore you get inflows. So the reality of the situation, without passing judgment on why these people are where they are with their performance, is that Platinum's numbers are negative on 1, 3, 5 and 7 years. Magellan's numbers are positive on 1, 3, 5 and 7 years. That's, again, not passing judgment on why Care or Hamish has made those choices in their stocks or whether they're going to revert in the future. Flows, so even if EM outperforms here for a while, flows are very slow moving things. Once people make up their mind to put money in a fund, it generally stays on average 3 to 5 years. Which leads me to the second point, and we've blogged on all this before, so if you want to go on our website, we're fairly transparent about the decisions we make, is old businesses versus new businesses. So there's a thing called net flows, so which is your inflows minus your outflows. Now for everyone here, they'll have decisions. They might be buying a house, selling a house, getting older, retirement, asset allocation choices. So what happens through time as a business ages is people change their mind for all sorts of personal reasons. We've experienced this in our business. So even if you have $100 of inflows, on day 1 you had 0 outflows. On day 4,000, you might still have $100 inflows, but now $100 of outflows. So your net flows go to 0. Quite simply, Platinum's a 25-year-old business. The average age of the people there are older than what they were 25 years ago. Magellan, on the other hand, is a 10-year-old business. So Platinum has to work doubly hard to generate the same amount of net inflows than what it did 10 years ago. So which means, how do you generate inflows? If your performance is not good, you spend more on sales and marketing, which means your margins come under pressure. So that's the summary. There are more to it than that. So leaving it, there is one other part, valuation. You would think, given all that, that Platinum should trade at a discount. It actually trades at about a 10 to 15% premium at the moment to Magellan, which doesn't really make any sense given the headwinds it seems to be facing. And we think that's to do with the dividends. We think people don't completely understand the change in dividend policy that Magellan announced half a year ago. So Magellan now pays out 100% of earnings. So if you look at where their run rate for earnings are this year, that should be about $1.70 of divvies they pay, which will put it on about 6.5–7% yield currently. We think as retail investors come to understand that, they will essentially bid the price up to lower the divvy yield. And again, that's got nothing to do with the individuals involved and judgments on them as fund managers. It's all about just the businesses they run.
In relation to the pre-NTA, back in around September there was a big drop in pre-NTA, which hasn't really recovered. What were the main factors? Yeah.
Are you talking about the NTA or the share price?
No, the NTA. So the pre-NTA, so back in, was it January? There was a big drop and then a recovery to the NTA, and then again September there.
Two real factors there. I think global markets have sold off. I mean, so the global markets, the Australian dollars were down about 5.5% in October, and they're down, and they're down another. Well, as of yesterday, they were down about 3% this month. And rather perversely, quite unusually, the Australian dollar has actually started to bounce. So that's the main factor. We are presently unhedged. So those are the main factors.
And another question, just in relation to your cash reserves. Jeff Wilson would be is holding upwards of 30% in some of the Wilson Asset Management funds. Do you see even cheaper opportunities coming up? And would that mean that you'd like to have more cash on hand?
Well, we can redeploy cash, so we're not worried about that. Our view is that there's the old tension between timing into the market and time in the market. Over most long periods, unless you're an absolute genius, which I'm sure Jeff is, time in the market is more important than you're more likely to do well consistently through time in the market than timing into the market.
And thanks, Jack. And finally, what do you think can be done in terms of bringing the share price closer to the NTA? Yeah.
I guess that's a question we get asked a lot. Look, we still have, although I think it's unlikely they'll get exercised, we still have options overhanging the share price. We hope that once, we were hoping they get exercised, but now probably likely they won't get exercised, and it's not many of them. So we think once that issue starts to dissipate, that should solve part of the problem. Our length of history will affect it, hopefully some slightly better performance. But I also would like to make it clear that we do monitor our NTA discount compared to other global funds, and it's not that far of line, especially given we're a relatively small fund. So we're certainly not happy about it. We're certainly going to keep trying to do what we can about it, and that involves a semi-annual trips around Australia to every capital. But it isn't going to go away in a day. So you'll notice that the NTA gap did narrow a bit in April, May, around the middle of the year, and that was, I think, a direct consequence of the fact that Irene and I, with some help from Chad, rotated around Australia, meeting investors. And what I can tell you is that we're getting, we've got slightly fewer people in Sydney than we had 6 months ago, but generally as we go around Australia, we're getting more and more people turning up who want to hear the story about global equities, but also about ethically screened global equities. Snapshot. We were a bit worried about our Canberra trip in the middle of the year. We had 8 acceptances, and we thought, oh, well, maybe 3 or 4 people show up. It's a bit of a waste of our time and a bit of a waste of the cost of doing it. Actually, all 8 showed up, so we thought we have to keep on doing this. It was very. We were there on Monday. On Monday, we had about 24 people this time. So we are gradually building, I think, the interested investor base.
And just on that, thank you very much for being willing to come and let us, update us on where things are at.
Yeah. And by the way, just to be very clear, we're a small business, okay? We have I think it's about 1,300 shareholders in the Morphic Ethical Equities Fund, and I think about maybe at most a couple of thousand investors in the unit trust. And we just encourage people to call us. If you've got questions, call us. We don't want to be doing it all day, but we're certainly, if you want to call us from time to time with sensible questions, we're really happy to have a chat, both about the ethical screens, also about the stocks.
You mentioned that there were some options that could possibly be exercised, although the current share price won't encourage people to do that. What is the date or the month that those options are due to expire?
It's the end of this month.
Okay, thank you.
I'm more concerned about the possibility of dividend reinvestment. So rather than taking up options.
So we have a dividend reinvestment plan.
You do?
Yes.
And it's what? Determined on the price on the day?
It's determined on, we don't do it at a discount for price, it's at the price. I think it's a 5-day, five-day weighted average.
Okay. Well, I'll do that then.
Thank you very much. Thanks for the support.
Hi, I'm not sure that I quite understand why buying Coca-Cola Amatil would ever be considered in your initial screening. I don't quite understand that.
Well, the good news is we didn't. We've shorted it. So that means
Can you clarify that?
Sorry. What we've done there is we basically said we think Coca-Cola Amatil is overvalued, has unsustainable business practices, and that will eventually result in the share price falling. So we've gone and borrowed some shares from somebody who owns them, probably Australian Super or something like that, and we said we're going to borrow these shares. We have to pay some rent while we borrow them, and we then sell the shares we borrow, and then we hope to buy them back at a lower price in the future, and then give them back to Australian Super, whoever it is who originally owned them.
But I guess with the ethical, the screening principle, why even think about going with Coca-Cola Amatil?
No, but we do not own Coca-Cola Amatil. What we are trying to do is participate in the fall in those shares, which we think will be partly due to the fact that the stock is overvalued, and partly due to the fact it's got unsustainable practices. We think it kind of come home and haunt it. So just be very clear, we would never buy Coca-Cola Amatil. It's a company, but we do feel we have a right to short those companies, and when we do short them, we tell the story as I've just done now about why we think it's an unsustainable business. Do I feel lunch o'clock creeping upon us? Some hungry stomachs. If there are no other questions, we're going to be around, and I'd like to encourage you to meet the rest of our other members of our investment team who are here as well. The tireless Irene, who is the face of our company in many respects. Eva, who is mostly in Hong Kong, but is down here to help us and responsible for our much improved look of our presentation. So please do hang around for some lunch, and thank you very much for your attendance.